Hello and welcome. You with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. Weak global cues take Dalal Street to its lowest level in 2 months. Sensex and Nifty lose over a percentage each. Mid-cap index falls over 3%. Rupee weakens to an all-time low of 81 rupees and 65 paise to the dollar as fears of global recession send the greenback surging to multi-year highs against most of its rivals. All eyes on RBI's rate decision later this week. Brent Crude slips to an 8-month low of $85 a barrel. Fears of recession and a skyrocketing dollar burns the market. Price is down 18% this month. Later on the show, we get you an exclusive conversation with Nirmal Jain of IIFL Group, where he talks about his outlook, rate hike expectations, and the steep fall in the rupee. Unprecedented crackdown on online gaming companies across India. Gaming giant Gamescraft issued a notice of 21,000 crore rupees by the Director General of GST Intelligence. It's a big bang start to festive season. Samsung India sells over 1.2 million units of its Galaxy smartphones in just 1 day of online sales, worth 1,000 crore rupees. Four trading days and 13 lakh crore rupees of investor wealth wiped out. The Sensex fell over 900 points today to a 2-month low, while the Nifty closed 311 points lower. Dalal Street has had a rough past few days, with stocks falling on worries of global inflation levels and slower economic growth. Higher interest rates have become a major worry as the US Fed and other Western central banks raised rates last week to multi-year highs. India's Monetary Policy Committee is also meeting this week and will announce its next interest rate moves on Friday.
A massive 75 basis point rate hike announced on 22nd September by the US Federal Reserve, clearly indicating that the pain of inflation is not ending in the US anytime soon. A day later, the UK followed suit. Both the countries are currently grappling with prices at a 40-year high. The rate hikes, instead of soothing the jumpy financial markets, have made investors more jittery and uncertain as to when the upward march of the cost of money will stop.
At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation.
Inflation in India, which rose to 7% in August, is clearly beyond the comfort band of 2 to 6% set by the Monetary Policy Committee. Analysts say it is a given that the Indian Central Bank will also raise rates this coming Friday. A poll by Business Today TV reveals that a majority of respondents are expecting a 0.5 percentage point hike. There is, however, another school of thought which feels that the current inflation level is not as much as a concern as the potential economic slowdown which repeated interest rate hikes may bring.
Yes, we have some amount of this imported inflation problem, but our supply side is in good shape. Our core inflation, underlying inflation of our system, is not a concern. Domestically driven inflation has peaked out. Core inflation has peaked out. But can I make some statement about what will happen to energy prices abroad? No. Will we be immune, given that we are a major importer of many commodities? Are we immune to global trends? No. There will also perhaps be some turbulence to food prices given the droughts around the world, and even in India we have had uneven rainfall.
The US markets have been skidding for the past 40 days, with the Dow Jones Industrial Average having lost more than $4 trillion in market cap since a high of 34,152 on the 16th of August. India's stock market has lost around 13 lakh crore rupees in just the past 4 trading sessions.
almost all the asset classes are down,
Yes.
apart from equities. If you can look at the rupee, if you can look at the commodities like oil or even gold prices. So all the fall is coming at the same time, and that is something which is creating panic across global markets and Indian markets. So I think it's a very important aspect that investors should be very cautious at this point of time.
Another big victim of the sharp rate hikes in the US are global currencies, which have plunged to historic lows against the greenback. While European currencies are among the worst hit, the Indian rupee also touched its all-time low of 81.65 to the US dollar in trade today. The rupee has fallen by around 2 rupees 40 paise in just a week, despite the billions of dollars sold by the RBI. Bureau Report, Business Today TV.
Our global business editor, Udayan Mukherjee, joining us now. Udayan, domestic markets have been in a bit of a tailspin. What are you making of the kind of selling, the kind of hammering we've been seeing?
Well, we spoke about it, Abha, a fortnight ago, you'll recall, when we spoke last. And I did mention to you that it would surprise me a lot if the global markets did not see another leg down between now and the rest of the year. But it has happened probably a little sooner than I had expected. So this fall does not surprise me at all, because at 18,000 on the Nifty, I thought there was a lot of exuberance which was creeping into the market. Things were not that hunky-dory globally or locally. And sure enough, there's been global panic since then. The global volatility has shot up. The Fed seems absolutely relentless in its drive against inflation. And contrary to earlier expectations that rates might have peaked in the West. And I think what's going on, I mean, if we are talking purely about India, but sitting here, I mean, if I look at what's going on across the world and what's going on with currencies particularly, I mean, what's going on with the euro or the British pound versus the dollar is nothing short of scary, because we haven't seen moves like that in many, many years, if not decades. So I think there's a fair amount of panic and flux which is there in the global situation. And I'm not surprised that India has come off very quickly from 18,000 to 17,000 Nifty. And I think the last 1,000-point fall in the Nifty would have hurt quite a few traders quite badly. Now the key question is, India has been so resilient over the last couple of years versus in these phases of global turmoil. This time too, will it get off around this kind of levels, or is the market headed much lower down from here? So fingers crossed on that. But I think the next couple of weeks, and October, you will recall, has traditionally been a rocky market, a difficult kind of a month to predict. So, and many times bottoms have been made in the month of October. So we'll have to just negotiate the next 2 or 4 weeks pretty carefully, because I suspect the global situation might rock us a bit more.
With the global rout continuing, Indian markets have also fallen in tandem, with relentless rate hikes by the Fed, central banks around the world, adding to nervousness with investors. Will this lead to the market hitting a bottom yet again? Udayan Mukherjee, our global business editor, and I spoke with Nirmal Jain, founder and chairman IIFL Group, about the current market conditions. Listen in to an excerpt of that conversation.
You know, it's the global situation which is the problem. I mean, we keep talking about how India is outperforming, but the global situation keeps getting worse every month. How worried are you that if this continues, I mean, despite our strengths, the Indian market might get damaged as well, in line with what's going on with the global rout?
No, I agree with you. Then we can't be completely untouched by the global rout, and things are aggravated a lot more than what people expected. So if you look at the US interest rate, then the expectations of the peak rates have been going up every month, and now also people are talking about 4.5, but there's no clarity. You are in UK, you know it better than me probably, that the 2-year bond yield in UK has gone up from 0.4 to 4% in 1 year, and on top of that, so I mean, there are issues about supply chain bottleneck coming from China's zero COVID policy, the elections in many countries, including Brazil and Italy, and on top of that, the dollar appreciating is bad for all other currencies. So in this kind of environment, I don't think that one can be, live in a completely worry-free world that India is a sweet spot. Yes, India is doing better. And given the fact that investment, whenever the dust settles, if investment is not going to flow to China and Russia, then by default, India will have an advantage. But having said that, I think the volatility in the currency and the global markets will definitely impact India. And one more thing to worry about India is that the valuations have been at a high altitude. So there are concerns and one should be cautious.
Do you see the market going back to the previous bottom that we touched? I mean, we are still a couple of thousand points on the Nifty above that. Do you think a retest of that is likely through this painful phase, or do you think this time the bottom might be higher? The price damage may not be that significant. I mean, what's your guess?
I would think that India might do better because a few things, in terms of macroeconomic environment has been very good, tax collections are good, and India has managed the oil thing also very well by balancing its imports from Russia and other countries. So all things put together, and earnings of some of the sectors have been good. IT is a big sector that will benefit by currency depreciation, but I don't know. I'm not a technical analyst to figure out where the bottom and resistance are. But if you ask me, short-term volatility is there. But if you, at the same time, whenever the things, basically whenever US inflation starts heading down and things start recovering and there's stability, then India will be a big beneficiary, which is much different from the earlier crisis, because in manufacturing as well as investment, world is looking at an alternative to China, which is a large economy, and India stands to gain. And on top of that, the stability in political front here and the economic reforms, which government has been undertaking, they will also benefit the foreign investor sentiment. So, I mean, just to sum up, whenever things recover, India has a better chance of recovering faster. And Indian valuations, I think, will remain at a premium given the growth environment being very favorable and also the political environment being stable.
Right. Let me ask you a fundamental question, Nirmal, because while the world is panicking, of course, we'll get hit because of the route through FII outflows, etc. But fundamentally, the fact that we've got a Reserve Bank meeting coming up and where expectations are that they may even raise by up to 50 basis points, what about these factors like rising interest rates in India or some kind of earnings damage filtering in through the global situation? Do you think fundamentally one needs to temper down optimism at all over the next year or so?
I agree with you. I mean, the expectations and the optimism has to be controlled, and some of the speculative forces that had come into the market, there will also be a very sharp corrections there. Given, I think 50 basis point rate increase is expected in this week's MPC meeting, and primarily because the currency will be under tremendous pressure otherwise. So Reserve Bank will have to look at not only the inflation but also look at the the global developments, and particularly in the US, and the impact of that on the rupee, because a lot of money will now flow to, if you look at US mortgages are now at 6.5%, so obviously a lot of money will flow to US bonds and US debt market, and that basically will be squeezing the emerging market, and even India can be impacted. And under these kind of environment, I think interest cost will damage, and interest cost beyond a point can damage the demand also. While India will do better than the rest of the world, but expectations have to be moderated. And this year and next year, I think there will be earnings disappointment in many sectors, arising from two things. One is the cost increase because of interest and inflationary pressure in many commodities and even locally. And secondly, the impact on demand because of higher interest and this kind of environment. And also global markets, if they come under recession, then the exports will be impacted, and that also will affect many industries adversely. So I think, tone down the expectations. We may be better than the rest of the world, but still that doesn't mean that everything will be hunky-dory and any kind of optimism will be rewarded.
Okay, fair enough, and I guess we've been witnessing that in the last few sessions, Nirmal. But where does one look then for a safe investment when it comes to the markets right now? Would you go via specific pockets, or would you stay extremely stock specific at a time like this?
No, I would go rather, if the assets which are to be allocated to equity, I'll have a balanced approach. And at this point in time, if you see, market basically swings, and the two large sectors are tech and technology and bank. So earlier technology were hammered down and there were huge short position there, and long bank, and in last couple of days probably we are seeing a reversal of that. But as an investor, I'd probably make a balanced portfolio. Of course, bottom-up stock picking of fundamental good stocks is good, but otherwise sectorally probably one can have a balanced approach. So as far as India is concerned, you know, that maybe a little bit of sweet spot, because if the economy does well, even if 7% might become in a very conservative scenario 6%, then also is good. IT, bank, two large sectors, but even capital goods, engineering, all of them should do well, because government probably is, you know, will continue to invest aggressively in infrastructure. Tax collection is good, so that basically gives some more strength to the government's determination or resolve to make sure that they try to propel the economy as much as possible. So I would say that, you know, make a balanced portfolio. I mean, that's the best thing to do.
You can catch the full interview on businesstoday.in as well as our YouTube channel. The rupee rout continues, with the Indian currency hitting a fresh record low, with the dollar index at a two-decade high. The rupee plummeted to 81.62 versus the dollar at the time of close. The greenback rose sharply against most major currencies on fears of a global recession from the rising borrowing rates worldwide. The US yield rising to a 13-year high added to the vulnerability of the rupee. It was not only the Indian rupee that was taking a hit. All Asian currencies were in the red. All major currencies around the globe tumbling versus the dollar this year. It's the Pakistan rupee, the pound, the Japanese yen, all falling over 20% compared to the dollar. The Chinese yuan, euro and South Korean won have also witnessed a major fall as the dollar momentum picked up. Unprecedented action against online gaming companies in India underway, with the Director General of GST Intelligence issuing notices to all such companies in the country. Sources say the department is looking at recovering more than 2.5 lakh rupees from the online gaming industry. My colleague Karishma Sudani has more on this.
Well, absolutely major tax crackdown when it comes to GST. We are being told that DGGI, which is Director General of GST Intelligence, has started issuing show cause notices to various online gaming organizations and companies because of certain GST tax evasions and fake invoices being submitted. Sources have told us that the Bengaluru wing of GST department has issued a show cause notice worth ₹21,000 crore to Bangalore-based online gaming company called Gamescraft Technology. In fact, Gamescraft to Business Today Television has acknowledged about this show cause notice and is of course wanting to cooperate in this whole investigation. But we are picking up that the government is now of course tightening the nose and will look at further recovery. In fact, sources have told us about 2.5 lakh crore recovery is what government is expecting from online gaming industry. Recently, Supreme Court also has issued notices to certain online gaming companies. All this comes in the backdrop of what the GST Council will actually do when it comes to taxation. Next month when they meet, is it going to be 28% tax on online gaming? The debate still stands if it's skill gaming, chance gaming or just mere betting that most parties to this argument have been saying. Thanks
for that, Karishma. In a signal of consumer priorities amidst high inflation, Samsung India has said that it sold over 1.2 million units worth an astounding 1,000 crores of its Galaxy smartphone, and that too on the very first day of online festive sales. Samsung has slashed prices of Galaxy series smartphones between 17% to 60% this festive season. Meanwhile, the consumer electronics giant has launched a co-branded credit card with Axis Bank.
As we kickstart the festivities, we're really happy to announce the launch of the Samsung Axis Bank credit card. And coming to your question, we think that this card is going to be a major affordability lever going forward as well. The industry is poised for a double-digit growth, and Samsung is poised to, we are targeting a 30% growth over the previous period during the festive season. And we've had a very great start to the festive period. On the first day of the online sales festivals, we've basically sold 1.2 million Galaxy devices and business of about 1,000 crores in one day. So it's a great start indeed, and we're looking forward to more.
While fears of recession are looming large, casting a shadow on the jobs sector, a survey conducted by Aon has given a ray of hope amid the gloom and doom. Salaries in India are expected to increase by 10.4% in 2023 as compared to an annual rise of 10.6% to date in 2022. My colleague Sakshi Batra spoke with Jang Bahadur Singh, director from Aon. Here an excerpt of that conversation.
You bring in the good news for us, so help us with some of those highlights that give you the confidence that in an otherwise, weaker sentiment kind of market that we are in right now, when everybody is talking about perhaps, a recession coming in globally in the developed markets in 2023, your survey actually indicates that back home, salaries would actually increase. That could be a complete contrast and a happy news for, people back home in India.
No, absolutely. I think you've already spoken about the headwinds, actually, and that's a fact that remains, be it around volatility or be it around geopolitical uncertainty. But the fact of the matter is that majority of the Indian, the number that we see is also backed up by some very strong tailwinds, which is one that if we look at the Indian corporate India today, one is that there is a fair amount of the corporate sector which is actually decoupled from the global economy. Now, I'm essentially talking about the more traditional sectors like hospitality, real estate, manufacturing, auto. And all of us have seen how demand is picking up, especially in the rural segment. Flights are absolutely full. People are talking about revenge travel, revenge buying. So there's a very, very strong sentiment that is being driven by the homegrown consumer. The second piece is that while, yes, if we look at these headwinds in the US and the other Western economies, they are likely to have an impact on our IT and ITES sector. Okay. But the demand for these sectors, for digital talent, for those services still remains strong. So what we're essentially observing is that, yes, as compared to 2022, the overall number for India comes down from 10.6% to 10.4%. And a lot of that downward trend is also being experienced in these sectors. Having said that, there are still very real, from an input side perspective, the war for talent is still raging on. It has only probably moderated to a degree. It hasn't really subsided. And in such an environment where everyone is going after digital talent, in India, what we've realized is that it's a very demand-supply driven metric when we look at salary increases. And these are some of the factors that are contributing to an absolute number that continues to be one of the highest in the last 5-6 years. Whereas if we look at it from a year-on-year perspective, maybe yes, from 2022, there's a slight moderation down to 10.4%.
Okay, so double-digit salary increase, that's a positive. It's slightly moderated from the previous year. It could moderate in the year 2023, and that could be because of the global headwinds that we are facing right now. But when you talk about, perhaps some of the sectors you mentioned, IT, which is not seeing some good days right now. It's facing a lot of pressure because of the kind of slowdown that we are seeing in US, which is their largest client. But which are the sectors that you expect to give these maximum or highest salary increases, going forward from here?
Yeah. So interestingly, while there is a downturn in sentiment in the IT sector, if we actually look at the top five sectors from an overall absolute number perspective, that actually continue to be these similar ones. So we are looking at e-commerce, we are looking at high tech, we are interestingly looking at professional services. But one segment probably which will be the silver lining in all of this would be the ITES.
And so we leave it on the show tonight. Thanks so much for watching.